So how are passive activity expenses and losses characterized? Well, if you're engaging in a passive activity and you have income, that's passive income. If you have expenses, those are passive expenses. You take the income, you compare it to the expenses, you come up with a net profit or loss. That's either a passive income item or a passive loss item on a net basis. Okay, again, why is this important? Because without the benefit of the $25,000 special exemption or without the benefit of real estate professional status, these losses are not deductible unless you're offsetting passive sources of income. To make things even more complicated here, expenses and losses that exceed passive activity gross income in a particular year may be applied retroactively backwards or carried forwards until such excess is utilized. It's important to note here that the passive activity rules apply to individuals, trusts, estates, personal services corporations, and closely held C corporations, but not to S corporations and partnerships. But you need to realize the S corporation and partnership losses are going to carry the same character out at the entity level down to the individual level, and they will apply there. And I mentioned this before, a taxpayer owns an interest in an activity that's a limited partner is not treated as materially participating in the activity by definition. It's also important to note here that a business can be qualified as a trader business, but if a participant in that business does not materially participate in that business, you could still wind up with passive income. Investing in the capacity of a limited partner is a good example of that. Also, if you're a 2% shareholder in a major corporation and you're not providing any services, you're not part of the management team, you're not making the decisions, ongoing operations of that business, it's passive to you. Again, material participation means that taxpayers involved in the operations of that business on a regular, continuous, and substantial basis. Moreover, this determination is made on an annual basis, year by year, and it can change from year to year. Again, passive activities include rental activities, most rental activities, unless they meet those exceptions by definition. And what's important to note here is rental real estate is passive even where the taxpayer materially participates, by definition, unless their participation rises to the level of a real estate professional, in which case it won't be a passive activity anymore. And the whole point here is that a taxpayer usually cannot deduct the losses of rental activity, even where he or she materially participates. Remember what's involved in being a real estate professional. A taxpayer's rental activity is not a passive activity if the taxpayer, one, materially participates in the activity, and two, most importantly, number two, performs qualifying services in real property trades or businesses to pull you into that real estate trade or business category. The bottom line here is that real estate professional is largely based on the facts and circumstances analysis, and you're at risk if you take that position and you're wrong.